The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, it was a good start to the week on Monday for soybean oil, continuing to get some support from Friday's EPA RVO announcement. Meantime, the livestock sector had a really good start to the week, a good rebound in cattle and hog futures on Monday. Quarter wheat, though, continuing to struggle a bit. Let's take a look at what's happening in these markets. Joining us, Sean Hackett with Hackett Financial Advisor. Sean, welcome back to Market Talk. It is good to hear from you again. Hope all is well.
Yeah, things are really good, and we're obviously getting into the core of the growing season. So this is when things start to, no pun intended, heat up a little bit. So
yeah, that's a good point. Well, and I definitely want to talk weather with you here as well a little bit later on. I just want to start with your thoughts on the EPA news we got Friday, which really has lended some support, it seems, to soybean oil, especially a little bit into soybeans as well. And that was kind of the star of the graded oilseed complex here on Monday, Sean.
Yeah, I mean, it was something that the market had been talking about since the beginning of the year. We had thrown out some numbers, and then there were some questions whether it was going to be lower and when would they come out with it. And they finally came out with it. It was on the higher side. And if you look at the ending stocks that the last USD report suggested we were going to have on soybeans, you add some extra demand for bean crush to meet these mandates going into next year. And, we're starting to push levels that get awfully tight. It wouldn't take much further reduction in supply from a crop, the crop that we're trying to grow here, to create a situation where we might need, $1 or $2 higher on soybeans to maybe factor that in a little more closely. So soybeans look like they have some tailwinds at their back, and I think that we might be looking for an uptrend, because don't forget, we're going to have to draw millions of extra acres towards soybeans next year, and I don't think $10.50 give or take is going to do it.
No, that's a good point. Well, and it's for as much enthusiasm as we're getting in the soy complex amid that EPA announcement. Doesn't seem like much of that's really translated over to the corn market for the corn ethanol side here, as we look at, for instance, D's corn finishing at that 435 mark, just kind of bumping back down against some key support levels, it seems right now, Sean.
Yeah, I mean, certainly the mandate increase is really a bean oil story for now. We really haven't gotten a whole lot of exciting information on whether we're going to convert any ethanol over yet. That's still to be determined. Obviously, we don't know exactly how many acres got planted, but it does look like we are going to get those higher numbers planted that the USDA said at the end of March. And, that means we need a little help. We need some Mother Nature help if we're going to get that down some. I mean, I think 1.75 billion bushel carry out, which is not, the biggest number we've ever seen. At the same time, it's certainly nothing that's going to get the market to worry yet. We need to start thinking about, is that trend line going to go from 181, 182 maybe to, like it was last year, upper 170s? If we do, then we start pushing 1.3 to 1.5 billion bushel carryouts, and then the market can start thinking about a $5 handle again. But right now, the weather's been kind of wet where it needs to be, and we do need to see Mother Nature worry the market in July. And the weather models, as of yet, are not giving the market for corn anything to get excited about just quite yet.
And that's a great point. And diving into the weather thought a little bit more, it's almost as if the old-fashioned weather scare is just not anywhere to be found in these markets right now. There was a lot of talk about Corn Belt drought starting to maybe, show up on a widespread scale by this point in time. But to your point, that's not really there. There's some regional drought issues, or it's way too wet in some areas. But by and large, I guess that old-fashioned weather scare is just not out there in these markets right now.
Yeah, very, very hard to excite the market on too much rain. The market's been taught the famous, statement, rain makes grain until it's proven otherwise. And but obviously, July is the key month. June, we've had a lot of hot, dry Junes that led to good Julys, and the crop comes out okay. So it's not over yet. in our advanced weather work that we do independently does suggest that let's kind of go backwards just a little bit. The last 6 years, we've had very challenging May, June weather patterns that led to a good July. This year, we're having a very good May, June that we actually think is going to lead to a more challenging July. So normally we're rallying this time, and then we fall in July. We think, we're going to struggle into late June, and then July we could actually have a nice rally into the latter part of July into early August. Something a little bit of a different pricing pattern than what we've seen in the last, let's say, 5 or 6 years. But until those weather models start showing heat and dryness where it counts in the middle of the country, in those ice states, the market's going to just assume, well, those trend line yields are going to be good, and why worry? But we do think starting, I would say, just the way the weather models tend to get here later, at the end of later next week, we do think that the weather models are going to start picking up on a drier, warmer July where it counts. And I think then the market can start seeing some short covering by the funds, and we might start to see a different trade. But until then, just not getting it.
So it almost feels to me that for quartered soybean producers, when it comes to their risk management right now, you almost have to take a bit of a wait and see approach here as we just don't have that excitement in these markets. Maybe we can get some short covering, things like that. I know a lot of producers, Sean, just haven't been too excited to do any sort of forward marketing when it comes to quartered soybeans here right now with how this market has been trading as of late.
Just remember, we had a good opportunity earlier in the year on old crop supplies, and we took full advantage and made aggressive recommendations to kind of really get yourself at least 3/4 sold on the old crop supplies from last year. But you're correct. On the new crop side, we just really haven't gotten, since that high earlier in the year, anything to get excited about. But my also view is that we're early in the season. It's very, very rare that you go through an entire growing season, whether it's here or overseas, that you don't get at least something to worry the market, even if it's just for a couple of weeks. And I still think that if we look at what we think is going to happen in the U.S. and over in, let's say, the EU and Russia, Ukraine, we think there will be enough to worry about, at least for a little while, to get that short covering rally, to get that weather market going a little bit, so farmers can look at the price, pencil it in, and it will make sense to do so. So right now, while the temptation is it's all over, there's no hope, no future, we would try to be patient, not get too excited about overplaying the fact that we have not gotten a rally yet, and look for the opportunity, but have those price points in place. The markets are moving fast these days, and don't fail to miss the window that we think will offer itself later on in July.
And of course, we always remember that risk of trading futures and options can be substantial. And you look at that wheat complex too, Sean. I know we had a real good rally as we got into the month of June, but we've started to give that back. I know winter wheat conditions look pretty good. Spring wheat growing conditions have been, by and large, pretty good. I mean, what's your assessment as you take a look at this wheat complex as a whole right now?
Well, I mean, winter wheat, at the end of the day, we're starting to harvest. We're going to be harvesting it. And, it's pretty hard to hurt the crop too much anymore. We've already had a lot of information about how big the HRW crop is. So I think questionably on the SRW crop, all that cold, wet weather, I think the market's way too optimistic about how production will kind of play out there. So I think, the way I'm thinking it, we've priced in the bearish crop idea on winter wheat. And I think the post-harvest rally that typically happens as you get into late June and July is going to take place. And especially if we get some excitement over SRW being a little lighter. Obviously, with spring wheat, the Minneapolis wheat side of the equation, crop conditions are really kind of actually below normal. And we think the worst of the hot and the dry weather will be felt in the northern plains into those Canadian prairie areas of Canada where they grow most of it. And I think there'll be more excitement to put weather premium into the spring wheat crop, the Minneapolis spring wheat crop. So I think if we're going to be looking at any weather excitement, spring wheat's still a market that I think has yet to really price that in. And I'm not so sure, like in HRW, that the Minneapolis wheat crop's been made yet. I think it's still a lot to be desired to say that crop is in the bin already.
Fair amount of producers across the South have really been inundated with water, and I know that's something to pay attention to in terms of cotton price action right now, Sean.
Absolutely. I mean, a cold, wet, deep south, southeast, it's just not the making. I mean, anyone that understands cotton knows it's a hot, dry, some rain, but I mean, it's a hot crop. You need the heat to bring it in. Cold, wet actually will produce a fairly unexciting crop, and the quality of the crop will be downgraded from what it's supposed to be. I think that's a kind of a flashpoint. The acreage report at the end of the month that will tell you how much we actually planted, I think, will be surprisingly lower for cotton than it was at the end of March planting intentions. And if you look at those balance sheets, it's not going to take a whole lot of change in supply or a whole lot of change in demand if this trade deal that we've apparently signed with a shake can, we get some more details of what that means for extra demand for maybe cotton. It would take a whole lot of change in those numbers to get ourselves into a uncomfortably tight spot. Certainly not projecting any wild, dollar a pound of cotton anytime. But if you're looking at a chart, we've been trading the 65, 68 cents for a long time. Wouldn't surprise if we could punch ourselves into the mid upper 70s for a little while on recalibrating what actual production should be and what those ending stocks will be for the U.S.
We're talking with Sean Hackett from Hackett Financial Advisors here today on Market Talk. Let's go over to the livestock sector, Sean. Really good start to the week for both cattle and hog futures. And I know stock market rally probably helped a little bit there on Monday. This cattle complex, when it looks like it's getting tired, it's done it time and time again here recently where it just, I think, surprises everyone and finds another leg higher. I mean, what's your thoughts as you look at cattle right now?
We did a 60-year price analysis on cattle, and we went back and looked at all the major tops that occurred. When did they occur? Why did they occur? And there's a couple of takeaways. One takeaway is that we tend to make a major high in cattle when the year that we start herd rebuilding, which every indication to us says we have started that this year. We've seen a major top in the third quarter of the year that herd rebuilding has begun, which means the market sees what's going on. It gets excited about it, but prices the increase in supply well in advance. The second thing is anytime we've seen diseases come into the fray, how long do those diseases tend to play out in the mind of the market? You tend to have a 6-month fuse from like this time around the screwworm situation and what that means for the price for cattle and that sort of thing. And if you run when we started worrying about screwworm and when we think we're going to burn ourselves out of trading screwworm, everything says that the third quarter is the likely period for a final high here, as you said correctly, in this market that's been extremely resilient. Interestingly, though, the hog price market, the hog price, has been outperforming the cattle price since early April. We haven't seen that happen for quite a few years, and that's telling me that there's a subtle shift going on in demand away from higher priced red meat beef to the lower, more economical price pork protein. And once that switch gets going, it tends to go on for a considerable period of time. Many times throughout history, we've seen this hog to cattle ratio get so skewed towards cattle, we get back into parity within 2 years' time. So it wouldn't be surprising to us that a couple of years from now, when we're looking at the hog price and the cattle price, they may be very similar in price, from the cattle price coming down and the hog price continuing to ratchet higher. We think we're in the early stages of that process. Good for the hog producer, but for the cattle producer, our idea is this is probably your final shot here over the next 1 to 3 months to protect and maximize that cow equity that you've built over the last several years. Once it goes, we know that the cattle business can be very challenging. Don't fail to take advantage of this opportunity. Nothing lasts forever. This won't either as well.
Yeah, great thoughts there. Manage that risk while you have the opportunity. Because to your point about demand, that's something I've been tracking with the meat demand monitor from Kansas State. We're starting to kind of see that show up where folks are trading down to say pork chops instead of getting a ribeye steak, just because that price at the meat counter, Sean, personal finances, credit card debt, and et cetera, the overall economic health for many Americans, it just seems like it's been slow in some ways, I think, but it's starting to finally catch up and show at the meat counter, Sean.
When you follow consumer sentiment index, which is a measure of how the consumer is feeling about the future, it's all psychological, whether they're right or wrong, but we've seen that index crash here in the last 6 months due to the tariff war and the stock market having convulsions. And that is extremely tied to how comfortable in the mind of this consumer that they're willing to pay for that high priced beef if it's high. And that's, I think, is a very important change in why I think that we're seeing this inflection point between, red meat versus pork protein and the price disparity. And unless there's a dramatic change in that index, and I don't expect that we're going to see that, that means what's going on here is a big sea shift. And even though the herd rebuilding that's keeping those animals even tighter is masking that demand loss, it won't last forever.
You track the dairy market. How about some thoughts for our dairy producers here on the show today? What are you watching this week?
Well, as you know, last year it was all about avian flu, and the reduction in supply. And once again, that burned itself out. But the market is still in a very, very tight global situation. No one in the world is growing or producing a lot of dairy. And what we're seeing is that Asia and China are starting to see an improvement in their economic outlook, and we're starting to see improved demand for dairy. And Asia demand for dairy is really the key to how the global milk market interacts with each other. And so we're pretty constructive here that we're not going to see any kind of an oversupply or a surplus of dairy anytime soon. And so we have seen, by the way, the price of dairy go up from the 16, 17 area to the 18.5 to 19.5 area. And so we think we're going to stay closer to 20 than closer to 16. And that, while not the best price we've ever seen, where feed prices currently are, the U.S. dairymen will do okay there. And we think it's going to be an okay outlook for them going into the end of this year.
Sean, always appreciate the insight. If folks want to reach out to you for a conversation there at Hackett Financial Advisors, how can they get in touch?
Our website is Hackett, Hackett advisors.com. We have a Twitter page at Faradix11 that they can look and read about some of the things we're doing and how we're looking at the world to see if what we do and why we do it might be of value to those watching your show.
HackettAdvisors.com for more. Sean Hackett, always appreciate the time. Thanks for joining us. Have a great week. We'll talk to you again soon.
Thanks, Jesse. Always a blast.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.